Good evening. This is Richard Kapsch, Managing Director of Pride Holdings in Schaumburg. Talking to you from Schaumburg today. Last week, this is going to be the second week we cover options. Last week, we talked about the basics of options. And at the time, I said that options have a big advantage over regular trading. Because of the options flexibility, and two, the possibility that we can have multiple strategies for just about every market situation. Today we're going to talk about some of those strategies. Today will just be a sampling of what you can do with options, but it'll give you some idea of the capability of options. Okay, before we do that, however, I want to go over some caveats regarding option trading, some warnings regarding trading in options. And the first is that only professionals should initiate positions by selling options. Now, as we pointed out last week, if you buy an option, your risk is limited to the premium you pay. However, when you sell an option, you have a virtually unlimited risk, or at least very high risk. And only professionals know how to manage that risk. They manage it by hedging their option positions. Later in this session, I'll show you one strategy where you too can sell options that's fairly safe. However, in general, only professionals should initiate positions by selling options. Now, the second caveat is you don't have to exercise an option to exit a position. You can simply sell the option and collect a premium to offset your initial purchase. If you buy an option, let's say it's a call or a put, and the market moves in your direction, if it moves up if you purchase a call, or down if you purchase a put, the premium should increase also, giving you an opportunity to make a profit. All you have to do is sell and pocket the difference between the price or the premium you sell at and the premium you originally purchased. If the market moves against you, you can also sell and recoup part of that premium. You don't have to wait till it exercises or the option expires to get out of that particular option. You can sell it at any time, and your loss would be the difference between what you purchased it at and what the premium was when you sold it. The bottom line is you don't have to hold on until the option expires. That's an important point to remember. The third caveat is if you are of the mindset that all you can lose is the premium you paid, you will probably lose that premium. Now, what am I talking about here? Last week we said, okay, you can purchase an option. The cost of that option is the premium you pay, and you don't have to put in any additional margin. Now what happens is too many people say, okay, I paid the premium and the most I can lose is that premium. If they go in thinking that that's all they can lose, they're probably going to lose that premium. It'll probably expire at a loss. So the point is you should trade options like other instruments. The best trade, you have to remember we talked about the three factors that contribute to a premium. One of them is the time value, and as that option approaches expiration, that premium constantly decreases, the time value decreases. So if you've purchased an option, you always have that working against you, so you have to remember that. The best trade is if the market doesn't move in your favor shortly after you bought the option, get out of that option, recoup most of the premium and save the money for another trade. Okay, let's look at some very simple strategies. And these are fairly obvious. If you're bullish, the simplest strategy is to buy a call. As we said, you have unlimited risk when you buy that call, and you have unlimited profit potential. So limited risk, unlimited profit potential. The one problem with it is time is always working against you as a buyer. Now you can also sell a put, but if you sell a put, your profit potential is limited to the premium you receive, and you've got virtually unlimited risk. So for a new trader in options, the best strategy, the simple strategy, if you're bullish, is to buy that call. Don't sell a put, because you virtually have unlimited risk. The one positive thing about selling a put in this situation, I should say selling a call and selling a put in this situation, is that time is working for the seller. It's always going in his favor. Now you might ask, why would it, if all the advantages to buying a call, limited risk, unlimited profit potential, no more margin calls, why would anybody sell an option? And the answer is professionals sell options because they gain positive cash flow. When they sell an option, they collect the premium, and that's money going into their pocket. When you buy that call, the premium goes out of your pocket. So professionals like strategies where they've got cash flow coming in. And as I said, we'll show you an example of how what they constantly do is hedge that risk, that virtually unlimited risk they have, by taking long futures or currency positions against the short option and constantly making sure that their net position is zero. So just remember that when premium professionals sell options, that they're constantly managing that risk, and they understand that risk, and then they treat it as a full-time job. So unless you're a professional, I advise to, if you're bullish, to buy a call. Okay, the converse of the bullish strategy is the bearish strategy. If you're bearish on the market, you buy a put. Again, like the call, you have limited risk and virtually unlimited profit potential. That market could go to zero, so it's not unlimited, but if it goes to zero and you bought a put, you're going to make money. And again, like the call, time is always working against you. That time component of the premium is constantly decreasing as that option approaches expiration. Again, the converse of buying a put, if you're a professional, is to sell a call. And like selling a put, you have unlimited profit potential. You have limited profit potential. It's limited to the premium received and virtually unlimited risk. But the one positive thing that works with the call is that the time is always working for the option seller. As the option approaches expiration, the time value of the premium is constantly decreasing, which works in favor of the seller. Any questions so far?
No, sir.
Okay. Let's take a look at another strategy. These are a strategy involving an option and a stock, and we're going to use, in this case, securities. However, you can also use an option and a long currency position. And this is called a covered write, or what we call writing a covered call. Writing a call and selling a call are the same thing. So when we say a covered write, we say we're writing a call, and it's covered by some long either futures or stock position or currency position that covers the short option. And we'll go through this example and show you how it works. But the purpose of writing a covered call is to generate extra income for an investor, and it's a fairly safe trade. Okay, let's take an example. We've got, let's say we are long, we have purchased 100 shares of IBM stock at a price of 161.875. Okay, and obviously since we purchased the shares of IBM, we hope that the price of IBM increases in value as we hold on to those stocks. Now, what we do in the case of a covered write is we sell one IBM February 165 call against it. Okay, on the CBI, Chicago Board Options Exchange, every call calls for the delivery or sale of 100 shares of stock. So when we sell one IBM February 165 call, that's the equivalent to offsetting 100 shares long the stock. Okay, if you remember now, an IBM February 165 call gives the purchaser the right to exercise that call should the price of IBM move above 165. Okay? So let's say the premium that we receive for selling that call is $6.375 per share. So that's premium that the seller receives in addition to holding on to the long stock. Okay, what happens now as we go forward in time? Okay, suppose IBM between, let's say, the time you purchase it and February, suppose IBM does not move at all. Your shares of stock remain the same at roughly 161 or 162, but that call is an out-of-the-money call, and that means the person buying that call from you will not be able to sell it because IBM remains under 165. So you collect a premium of $6.37 per share. Now, as we move forward to February, if IBM stays under 165, that call expires, so the person purchasing it from you can't exercise it, and you get to keep the $6.37 a share in addition to whatever profit you hope to make in the price of the stock. Then in February, if that expires, you can do the same thing over and over again. As long as IBM stays under 165, that call does not get exercised, and that's an additional income that goes into your pocket. In this case, the risk of selling that is relatively limited because should the call go above 165, the person would exercise the call, but then you would giving him the right to buy IBM at 165, but you have the 100 shares of IBM that you can sell him at 165, so you get that profit. The difference between the price you purchase at 161 and the price you sell it at 165, plus whatever premium you've gotten from any of these calls along the way. Okay, we call this strategy a covered write, and it's a fairly conservative strategy, but it's a good one if you've got long positions. Now, in this example, we used shares of stock, but there's no reason why you couldn't, let's say, if you were long a euro-dollar contract, selling euro-dollar options against it, as long as like in the last month or so, the euro has basically moved sideways in a relative trading range, and there hasn't been too many opportunities to make a lot of money trading in the euro. In this case, you could have been long the euro and sold calls against it And as those calls expire, you simply collect a premium, which would be in addition to any appreciation you get from the price of the euro. Does everybody follow that or understand what I'm trying to do here? Okay. Another strategy involving an option in the stock or an option in any long position is we call it the long stock, long put, which is a protective put. Okay, when we talked about trading, we said one of the ways to manage your position to follow a trend is to do it with trailing stops. And when you trade with a trailing stop, you run the risk of that market all of a sudden dropping down, taking out your stop, and then moving higher again and leaving you without a position. Okay, a protective put takes care of that particular problem. In this example, let's say we're long 100 shares of IBM at 161.875. What we do to protect our position is we buy an IBM February 160 put, which costs us $6.50 per share. Or we could buy an IBM 155 put at $4.75 a share. Okay, what this does is as you're long the stock, let's say the stock is moving sideways and you hope to catch a rising trend in this case. If you had a stop in at 160 and the market went down and touched 160, you get stopped out of your position. In this case, you can hold on to your long position. You also are long the underlying put, and you simply let it expire if as long as IBM remains above 160, and take whatever profit you can. And all it costs you is the $6.50 per share. Or you can buy one a little bit lower at 155 put, which when you exercise would stop you at 155. If the market drops below 160 and stays below that, you can exercise that 160 put and limit your loss to the difference between the price you purchased at 161 and the price you exercised to put it at 160. So you're buying IBM at 161, selling it at 160, and only losing $1 on that share in addition to the $6.50 per share. It's a little bit safer position than worrying about the market taking out your stops. Everybody understand that one?
Yes, sir.
Okay.
Okay.
Okay, another alternative strategy that we can look at is something called a spread. Now let's say we look at a premium, and if we're bullish or bearish or something, we could buy a call. We may not like it because the premium may be high. You can take a position, and a spread is taking a position in two or more options of the same type, two or more calls or two or more puts. And we'll go through an example. Okay, and what the spread does is enables you to reduce the premium you pay for an option. At the same time, it reduces the potential profit, which we'll show an example. But the return on investment is still substantial, or can still be substantial. Okay, what we do is we buy a call. In the case of a bullish position, we buy a call at one price, one exercise price, and sell a call at a higher exercise price. In this case, we have unlimited risk theoretically on the call we sell, but if the market moves above the higher strike price, you can simply exercise the lower strike price, and the position covers that short call. And we'll go through an example of this. So spread is taking a long and a short position in two options to reduce the premium and hopefully increase your return on investment. Okay, a bull spread and calls we use if we're bullish on the market. It reduces the premium paid. The downside risk is, remember, is equal to the premium. So if, and we'll show an example in a minute, but it also limits the upside potential. The strategy is to buy one call option, sell a second call with a higher strike price at the same expiration. Okay, let's look at an example. Suppose we're looking at Intel, and we're talking about stock options now. Suppose we're looking at the stock Intel, which was currently trading at a price of 143, and we're bullish on the market. Okay, we can go out and buy one Intel February 145 call, which is a little bit above the market, at a premium of 8.625, and that would cost us $862.50 if we simply bought the call and did nothing else. And if the market moves above 145, it has to go above roughly 151 before we make any substantial profit on that. But, and also remember, we paid $862.50. That's the maximum we can lose, but let's say we don't want to lose that much. What we can do is go out and sell a higher strike call. In this case, we sell the one Intel February 150 call and collect premium at 625 on it. So the net out of our pocket now is $862.50 we paid for the 145 call, minus the 625 we collect for selling the 150 call. So we reduce the net premium we pay for this position. It's only $237.50. Okay, now let's say that in this case, by selling that call, we've maximized the profit we can make on this call. If Intel moves above 150, okay, we can exercise the 145 call and buy Intel at 145. The 150 call would also be exercised, which would mean we would have to sell Intel at 150. So between the purchase of Intel at 145 and the sale at 150, you only make $5 on 100 shares is $500, but we've only paid a premium of $237.50 for that. The return on investment would be 500 minus 237.50 divided by 237.50 times 100, which comes out to about 110% return on our investment. So for a fairly simple trade, we've more than doubled our money. And we've been able to do that. Simply, we've reduced the profit potential, but we've also substantially reduced the amount of money we've had to invest. Everybody follow the call?
Yes, sir.
Okay. Okay, if you're bearish on the market, you would do the same thing with puts. The strategy would be to buy one put option and sell a second put option with a lower strike price, the same expiration. Again, what happens is you reduce the premium you pay, you also limit the potential profit potential, but should the call work, or should the strategy work out the way you want it, you can make a substantial amount of return on investment. Looking at an example of Intel again, let's say we think Intel is it's currently priced at 143, and we think it's going to go lower, okay, we can buy one Intel February 140 put, costing us $650, premium of $6.50 per share. This gives us the right to sell Intel at 140 should we want to exercise the option. Okay, as a spread, we sell one Intel Feb 130 put, which is a lower strike price. Because it's so far out of the money, we only collect $300 for that. So our net out of pocket is $350. The $650 we paid for the 140 put, and the $350. I'm sorry, the $300 we've collected for the 130 put. In this case, our maximum profit is $10 per share. If both options were exercised, we would sell Intel at 140 and be forced to buy it back at 130, so we make $10 on a $350 investment. That's a return of about 285%. Again, for a very simple, low-risk strategy. Everybody with me?
So.
Okay. Okay, now I said we're going to look at a little more exotic strategies, just to give you an idea of as I said, the flexibility of options. And one strategy that's fairly popular is something called the butterfly spread. The strategy in this case is to buy one call with a low strike price, sell two calls with a higher strike price, and then buy one more call with an even higher strike price. And we call it a butterfly because the two buy calls are the wings, and the two calls we sold are the body on this particular transaction. So we've got two wings and the body. It kind of looks like a butterfly once it's exercised. Now you would use this strategy if little price movement was expected. You get your maximum profit if the stock price remains very close to the middle strike price, and your loss would only be limited to whatever net premium you paid if the market should not stay close to the middle strike price. Let's take a look at the example of this one. In this case, let's say we've got IBM is trading at $160 a share. If we wanted to put on a butterfly spread, we would buy one IBM Feb 155 call at a premium of $12.125 per share. That would cost us $1,212.50. Okay. Now against that, we sell two Feb 160 calls, which are at the money calls. Remember, the 155 call is what we call an in-the-money call. Should you exercise it immediately, you get it $5 per share. The Feb 160 calls are at the money, where the strike price is the same as the market price. And the premium we receive for selling those two shares is $8.875 per share, or a total of $1,775 total premium that we collect. And then the third leg on the spread is to buy an IBM Feb 165 call, which is an out-of-the-money call, trading at a premium of 6.375. When you take the amount of money we pay minus $12.50, minus $637.50, and set it against the $17.75 we collect, but the total price we pay for this option is $75. Okay? Now what happens if the market stays around 160, and remember we got into this spread because we weren't sure. We thought the market was going to stay in a narrow trading range rather than moving up or down, and we wanted some kind of a trade. Okay, if the market stays at 160, okay, the Feb 155 call gets exercised. But the 160 calls and the 165 call do not get exercised. We paid a total of $75 for this. So the profit we'd make would be $500 on the 155 call, 0 on the 160 calls, 0 on the 165 calls, minus a premium of $75. So we collect $500 for a $75 investment. Okay. If the market should move well above 165, all the calls would get exercised. Again, our maximum loss would be $75. Should the market drop below 155 and none of them get exercised, again, all we paid is minus, none of the calls would be exercised. Our total loss would be $75. Here we've got a case, if the market rallies sharply, we lose $75. If it drops sharply, we lose $75. But if it stays at 160, we make $500. Everybody understand that? Take some,
yes, sir.
Take some time to sit in there, settle in. Okay, here's the profit. The market remains at 160. Profit on 155 call is $500. The 160 calls expire worthless at 0. So we get 0 plus a 0. 165 call expires worthless, also 0. Our net premium paid was $75. So our net profit is $425 for a $75 investment, and the market hasn't gone anywhere. Okay, I want to take a look at two more trading strategies that are what we call combinations or combos. And these are option positions or strategies where we take a position in both puts and calls on the same stock or in the same underlying asset. Could be currencies, could be futures, but the examples we're going to show are using stock. The first is what we call a straddle. And the strategy in this case is we can buy, or if you're a professional seller, sell both a put and a call at the same strike price and the same expiration. Now what will happen is, this is a strategy we put on when we're not sure where the market's going to go, but we think it's going to go somewhere. And we want to be positioned for that move. Rather than wait for the trend to begin, this gives us an opportunity to get in at the beginning on a market move. So in this case, we bought a call and we bought a put. Now, what would happen if the stock price increases, moves away from the exercise price, the buy call winds up making more and more money and premium it starts to increase. The sell put, the premium decreases, but decreases at a slower rate. So we got the net premium increases because of the premium we get. The premium attached to the call increases at a faster rate than the premium attached to the put. And what you would do in this case is, as the market starts to move up in this case, you simply sell your put and hold on to the call and ride it as long as you want until you're satisfied that the price has moved up. In the case if the market goes down, you would simply sell out the call and stay long the put and ride the put down as long as you can. Okay, now you can also, if you were a professional seller, you could sell a straddle by selling a call and selling a put at the same strike price. And you do this if no move was expected. If no move happened, both the call and the put that you've sold would expire worthless and you get to keep the premium. So this is something called a straddle. It involves buying or a put and a call at the same, as far as you're concerned, buying a put and a call at the same strike price and the same expiration. Here's an example. Let's say Intel is priced at 143. We would buy an Intel 145 call at 862.50, which means premium we paid out. We also buy an Intel 145 put at premium of $937.50. So the total position costs us $1,800. And if Intel moves above 145, let's say to 147 or something, what we would do is sell out the put and collect whatever premium is left on that and stay long the call. If Intel moves below 140, let's say, we would sell the 145 call, collect whatever premiums remaining, and stay long the put. Now, if you're a professional seller and thought that the market was going to stay in a very narrow trading range and you could manage that position, you would sell both options and collect $1,800 premium for it. If you're right and if the market doesn't move, then you get to keep that $1,800. So that's called a straddle. The call and the put are at the same strike price. Okay, a variation of the straddle is what we call a strangle. And in this case, we still buy a put and a call, or if you're a professional, sell a put and a call. But now we've got different strike prices. The call strike price is above the current market. The put strike is below the current market. They have the same expiration date. The advantage to the strangle over the straddle is you pay less premium to put this position on. In this case, if you bought this strangle, your payoff would increase as the stock price moves away from the exercise price. And again, you'd use this if a move was expected, but you're unsure what direction you'd go in. Again, if you sell a strangle, you get the maximum payoff if the strike price stays at the exercise price. So let's look at an example of a strangle. Okay, here we've got Intel at 143 again. In this case, we buy an out-of-the-money call at 145. The strike price is above the market price. Costs us $862.50 like we did with the straddle. In this case, we can buy a 140 put, which is also out of the money because the exercise price is below the market price. Costs us $650. So our net premium paid for the strangle is $1,512, which is less than the $1,800. Now again, we would make money if Intel moved above 143, moved above 145, we would stay long the call and sell out the put. If it fell below 140, we would sell the call and stay long the put. That way you're positioned for a move that you expect to happen. If it happens, hopefully you'll make money. Now again, a professional would sell both options and collect $1,512. As long as Intel stays between 140 and 145, between now and expiration, that professional trader gets to keep that premium of $1,512, which goes into his pocket. Okay, that's basically all I wanted to cover today in strategies. What I had hoped to do was give you a taste of some of the possibilities that are available in trading options. You know, as I said, you can have multiple strategies for just about any kind of market condition. Whether you think the market's going to rise, whether the market's going to fall, or if the market's going to stay the same. And depending on the degree of risk you're willing to take on, you can even sell some options. But it's worth following up and looking into these options a little more in terms of looking for trading opportunity. Okay, that's all I've got today. Any questions on anything I covered? Anybody still awake? Okay, thank you. Next week, we're going to talk about stocks, and that'll be on May 4th. Then on May 11th, we're going to redo this futures pod webinar that we did 3 weeks ago that didn't come through with very much. So May 4th, we're going to cover stocks. May 11th, we're going to cover futures contracts. Okay? So we'll talk to you next week. Thank you.